Hi there, accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover several questions from chapter 14, which covers bonds and long-term notes. So one thing to keep in mind, as we're dealing with bonds, we know that companies, they can borrow cash from banks or other financial institutions by simply signing a promissory note. However, with corporations, they have the ability to borrow cash by issuing bonds to the public. One key thing to keep in mind is that there's a distinction between stocks and there's a distinction between bonds. Stocks, that's essentially when you are investing into a corporation. So you have ownership in the corporation, no matter how big or how small, you are an owner, you are investing into a corporation. Bonds, on the other hand, you are lending money to a corporation, and the corporation has an obligation to pay you back. So with bonds, as mentioned, it obligates the issuing corporation to repay a stated amount. So this stated amount, it could be referred to as the principal, the par value, the face amount, or the maturity value. And they are promising to repay this amount at a specified maturity date. So maturities for bonds, they can typically range from 10 years to 40 years. Ultimately, it depends on the corporation. And in return for the use of the money that's borrowed that you lend to the corporation also agrees that they are going to pay interest between the issue date and the maturity date. So the interest is the stated percentage of the face amount. And sometimes this is referred to as the interest rate, the stated rate, the coupon rate, or the nominal rate. And as it relates to interest, generally it's paid semi-annually. So that means twice a year, and interest dates begin 6 months after the day the bonds are dated. So just wanted to give you a background of bonds. We'll start off with our first question, and it states, what is the amount of interest that Holiday will pay semi-annually to bondholders? As mentioned, semi-annually means twice a year, every 6 months. It says Holiday Brands issued $30 million of 6% 30-year bonds for $27.5 million. So the 30 million represents our principal, our par value, the face amount, or the maturity value. Our specified maturity date, we know that it's a 30-year bond, and our stated rate, coupon rate, nominal rate, interest rate, whatever you want to call it, is 6%. So we are promising to repay this $30 million in 30 years. And within that 30-year period, each year, bondholders will receive 6% worth of interest. But one thing we see here is that the bonds are worth $30 million. We're going to be repaying $30 million, but they only gave us cash of $27 million. So you might be asking yourself, wait, what? Why would that happen? One of the things that happens, is that there's bonds issued at a discount, and then there are bonds that are issued at what's called a premium. So let's relate it to everyday life, right? If you go to a grocery store and there's a low demand for items, they are sold at a discount. The same thing that happens in retail. As we are approaching the fall, there's no more of a need for summer clothing, right? Summer clothing is starting to go out of style because people are now needing long sleeve. They're now needing pea coats and things of that nature. So summer clothes, as the fall and the winter approaches, summer clothing, there's a lower demand. Therefore, they are sold on a discount. Vice versa, as we approach the summer, people no longer need long sleeve clothing. So winter and fall clothing now go at a discount. As it relates to bonds, here we see in this case, Holiday Brands is promising to pay 6% interest. The problem would be in the market, they are promising 8% interest, right? So if we think logically, if I invest my money into the market and they're going to give me 8% interest, why would I want to invest in Holiday Brands Corporation when they're only giving me 6%? So to compensate for that and to appease bondholders, bonds are issued at a discount. Vice versa, if there's a high demand for items, if we think about when COVID-19 took place, there was a very high demand for disinfectant spray, disinfectant wipes, toilet paper, water, paper towels, and things of that nature. There was a high demand for it, so they were able to increase the price and people had to pay a premium to get these items. So therefore, whenever holiday brands, let's say they are offering the bonds for 6% and the market is only paying 4%, there is a greater demand to have these holiday brand bonds because they are paying more. So in such case, bonds would be issued at a premium. So just wanted to provide a logical understanding of why a bond would be issued at a premium versus a discount. It's very rare that bonds are issued for face value because, again, there's differences between the stated rate, the amount that the corporation promises to pay, versus the market rate, which is often referred to as the yield to market, as we'll see in one of the problems. So problem's fairly simple. Just wants to know, what is the interest that they're going to pay semi-annually to bondholders? So we start off with the problem. The face amount, as we know, is 30 million. We multiply it by the annual rate, which it lets us know is 6%. And then we factor in the fraction of the annual period. So we know that payments are going to be made every 6 months. Therefore, 50%. So there's more than one way we can look at it. 6 divided by 12. All right, 6 divided by 12. And that's essentially going to give us 50%. All right, Excel not working. Oh, I know what I need to do. All right, let's see. There we go. Perfect. All right, so the fraction of the annual period is 50%. So the first thing we need to do is we multiply our face amount by the annual rate, which is 6%. So what this means is that each year in total, we are going to pay $1,800,000 worth of interest. But again, we are paying interest semi-annually. So therefore, all right, here this represents annual interest. But the problem is asking us to determine on a semi-annual basis, how much are we going to be paying? So how would we determine it? Simple. We can do 1,800 multiplied by the fraction of the annual period, which would be 50%, or we can simply do, all right, we're going to be paying them annual interest of 1,800. We're going to be making 2 payments per year. So 1,800 divided by 2, 900,000. So you essentially get the same answer, just a different way to calculate it. So our semi-annual interest payment would be $900,000. We're paying them $900,000 every 6 months for a total of $1,800,000 per year. So our interest paid will be $900,000. This brings us to our next problem. It asks to prepare the journal entries to record the purchase of the bonds by Wang Communications on January 1st, 2024, the interest revenue on June 30th, 2024, and interest revenue on December 31st, 2021. It states Universal Foods issued 10% bonds dated January 1st with a face amount of $150 million on January 1st, 2024 to Wang Communications. The bonds mature on December 31st, 2038. So it's a 15-year bond. The market rate of interest for similar issues was 12%. Interest is paid semi-annually, twice a year, on June 30th and December 31st, and Universal uses the straight line method. All right, so we mentioned that sometimes bonds, they can be issued at a premium or they can be issued at a discount. So one of the things that we need to account for is taking into account the difference between the face value and the difference between how much was received, if it was issued at a premium, if it were issued at a discount. So we need to amortize the amount that was recorded as a discount or was recorded as a premium. So we have 2 methods. The first is the straight line method, fairly straightforward. Just like the straight line method of depreciation, you essentially divide the depreciable basis by the number of years. Simple, easy. Then we also have what's called the effective interest method, where in such case, we determine the interest based on the carrying value of the bond. So we're going to see that in a future problem, but the straight line method is used in this case. Whatever the difference is, the discount in such case, we divide it over the number of payment periods. So here we know the face amount, we know the years, we know the market rate, we know the stated rate, and we know how often it is paid, twice a year. But what we don't know is the price of the bond. So in such case, we need to determine the price of the bonds. So the price of a bond issue at any particular time, it's not necessarily equal to its face amount. So in the previous example, we saw that it was issued at a discount. And in this case, we ultimately need to determine what is the value of the bond that was issued. So in order for us to determine the price of the bond, we need to focus on the present value of the periodic cash interest payments. And we determine that based on the face amount times the stated rate plus the present value of the principal payable at maturity. And both are discounted at the market rate. You might say, what? That doesn't make any sense. So we are going to work through it. So here we see that there are some tables here. We have the future value of $1. We have the present value of $1. We have the future value of an annuity of $1, the present value of an annuity of $1, fair value of an annuity due, present value of an annuity due. So in such case, we need to be able to understand the difference between, well, present value. That's basically like, let's say you want to have $10,000 in 5 years. With the present value of $1, we want to determine, okay, if 5 years from now I want to have $10,000, how much money do I need to invest today? That's the present value of $1. The future value of $1 is the reverse. If you say, hey, if I invest $5,000 today, how much is it going to be worth? What is the future value of the $5,000 that I invest today? A single lump sum. When we are dealing with a series of payments, so when we think of the series of payments, we think about the interest payments that are being made twice a year. That's a series of payments. That's an example of an annuity. So when we have an annuity due, that is when payments are made at the beginning of the year. So we have the future value of an annuity due, the present value of an annuity due, and our future value of an ordinary annuity or present value of an ordinary annuity. That is when payments are due at the end of the year, or more than once during the year. So in such case, we are using the present value of $1 for our interest payments, and we're going to be using the present value of $1 to determine the present value for this $150 million. So we'll start off with our interest. We need to determine the interest in this case. So how do we determine it? 150 million represents the face value of the bond multiplied by the 10%. And this represents interest for the entire year. But again, payments are made semi-annually, twice a year. So therefore, we can multiply this amount by 6 divided by 12, which gives us 50%, or we can divide it by 2 because we are making interest payments twice a year. So in this case, I'll divide it by 2. So our interest is $750,000. Again, how did we calculate it? It is the face amount of the bond, which is 150 million, multiplied by our interest, which is 10%. That gives us a total of 1,500. But then again, this represents the annual interest. We want to determine the semi-annual interest because it is paid twice a year. So every 6 months or twice a year, $750,000 is going to be paid. And then we account for our principal value, which is 150 million that is going to be paid in 15 years. So in order for us to determine the price of the bonds, we are going to discount the interest over the principal payments for the next 30 periods. So in order for us to determine, again, we'll start off with the interest. We use the present value of an ordinary annuity of $1. And our chart is as follows. So the number represents the number of periods or the number of payments. And on the top, we have the interest rate. So in order for it to determine which amounts we're going to use, we know that this is a 15-year bond based on the information. But again, payments are going to be made twice a year. So in total, how many payments are we going to be making over the life of this bond? 15 times 2 gives us 30. So N would be 30. And then as mentioned, we use the market rate. So this is called our yield to maturity, right? Because again, the bonds are essentially going to be issued as a discount. The problem doesn't let us, the problem does not explicitly state such, but as explained earlier, if the market is paying 12% and Universal Foods is only paying interest of 10%, why in my right mind would I invest in Universal Foods when if I invest in the market, I would get, 2% more, right? So to appease bondholders, they issue it at a discount. So again, anytime the market rate is higher than the stated rate, you can know that the bonds are going to be issued at a discount. And whenever the market rate is lower than the stated rate, we know that the bonds are going to be issued at a premium. So just keep that in mind. All right. So as we are discounting the interest payments and the principal, we use the market rate, right? So this 12% represents interest for the entire year, but we are looking at it from a semi-annual perspective twice a year. So therefore, we divide the market rate by 2, which gives us 6%. So 30 represents the number of periods, 15 years times 2 payments per year. 15 times 2 is 30. And the market rate is 12%, but that reflects interest for the entire year, but we are looking at it on a semi-annual basis. So 12 divided by 2 gives us 6%. So we basically connect the dots. 30 years, which is the second to last line, we move over to 6%. So therefore, our present value factor for the interest payments would be 13.76483. So therefore, the present value of the $750,000 received over the next, but let me see, 13, oh, I am missing a 0. There we go, 7,500,000. So I missed a 0 for the 150 million. Sorry about that. Perfect. So the 7.5 million payments is going to be received over the next 30 periods. If we discount it, the value of those payments is $103,236,225. So now the next step is for us to determine the present value of the principal 150 million that we promised to pay them at the end of the 30-year period. So we already know our number of payments is 30, and we already know our interest, which is 6%. So we are on the third to last line. We connect the dots. 6. So here we are. We multiply the principal by 0.17411. So the present value of this $150 million that we are going to pay in 15 years, the present value is $26,116,500. So when we add the present value of the interest payments as well as the present value of the principal, that lets us know that the bonds were sold for $352,725. So therefore, our journal entry would be as follows. And this would be on January 1st, 2024. So we're recording it on behalf of Wang. So therefore, we would debit investment in bonds for the full value of 150 million. Missing a zero. I'm going to make this a little bigger. Perfect. So we can see everything. All right, 150 million. The cash that we paid, we just calculated, is $129,352,725. So we see that we paid less than the value. So that lets us know that we issued, or we received the bonds rather, at a discount. So the face value minus the cash we paid represents the discount on the bonds. So therefore, we would credit discount on investment in bonds. So this will be our journal entry on January 1st, 2024. Now the next entry is for June 30th, 2024. So the problem wants us to determine the interest revenue for both June 30th and December 31st. So in order for us to calculate on June 30th, we would consider such. So how much cash are we going to receive, right? They promised that they're going to pay us the face value. I'll just write it here. Actually, the face value times the interest rate divided by 2, because again, they are paying us twice a year. So we calculated as follows: 150 million times the 10%. And then we divide this amount by 2. And that gives us the 7,500,000. So we are receiving cash of 7,500,000. And then now the next thing we need to figure out is, well, what is our interest revenue? And then we also need to account for the fact that we have to offset the discount on investment in bonds. So when we say that, we need to ensure that the value in this discount on investment in bonds account goes down to 0. So this takes us back to the basics of accounting. I'm going to put some T accounts here. So if we look at it from the balance sheet, so on the balance sheet, we would see an asset with investment on bonds for 150 million. And then we have this contra asset account discount on investment in bonds for for $20,647,275, right? So the carrying value of the bond would be calculated as follows. So the carrying value of the bond is always going to be the value of the investment in bonds minus the discount on investment, which is equivalent in this case to the cash we paid. But what we need to do is we are going to amortize the discount on investment in bonds. And the problem lets us know that we are using the straight line method. So what that simply means is that for this discount on investment in bonds account, I'm going to set up a T account. And this account originally has a credit. At the end of the period, we want this balance to be 0. So we know that in accounting, there's 2 sides. It's like a coin. It's either head or it's tails. There's nothing else. There's no in between. So with that being said, the credit side increases the discount on investment in bonds. And if we want to decrease the balance in this account, we need to do the opposite. So therefore, since it's going to be a period, $20,647,275, and we are depreciated it over 30 periods. It is a 15-year bond, and we're going to be making payments twice a year. So the value of the discount on investments in bonds divided by 30 each period, we are going to, and let's round it up. Each period, we are going to decrease this amount by 688,000. So every period is basically the same. And that's the benefit of the straight line. We divide the amount by 30, and just like the straight line, for every period, the value is going to be the same. So our journal entry would be cash for 7,500,000. We debit our discount on investment and bonds for the $688,243. And then the last part of the entry would be crediting interest revenue for the cash received plus the amortization of the discount on investment in bonds. And I want you to see here quickly. So if we multiply this 688,000 by 243, we multiply it by 30, we see that at the end of the period, the total debit is going to equal the total credit. So therefore, the ending balance is going to be 0. And the carrying value of our bond is going to be the investment in bonds minus 0, because this account balance is now going to decrease to 0. All right, so now for December 30th, we need to record the next interest payment. The great thing about using the straight line method is that the journal entry is going to be the same. We always amortize the discount on bonds investment for the same amount. So this represents our journal entries that would be recorded to solve this problem. Whoop, wrong thing. All right, so to record the investment in bonds, the first thing we needed to do was to determine the price of the bonds. We multiplied the semi-annual interest payments using the present value of an ordinary annuity, so PVA of $1, and we used the market interest rate, and we used the number of payments per period. So it's a 15-year bond. Payments are being made twice a year. So the number of periods is 30. The market rate was 12%. And again, we are looking for the semi-annual interest payment. So therefore, we divided the market rate by 2. And then we added the principal, which in this case was 150 million. We found the present value of $1 for 30 periods at 6% interest. We added the 2, and that let us know the present value, the price of the bonds was 129,352,725. And then for us to record our interest, we debited cash for the promised interest payment. We amortized the discount on investment in bonds. And again, since we're using a straight line method, our entry each period would be the same. The discount on bonds, the original amount of $20,647,275 divided by 30 periods. Each year, the interest, or the amortization rather, is $688,243. So this brings us to our next problem. And here we see it asks us to prepare the journal entries to record the purchase of the bonds by Saxton Bowes on January 1st, 2024, interest revenue on June 30th, 2024, and interest revenue on December 31st, 2024 at the effective rate. So here it says the Bradford Company issued 10% bonds dated January 1st with an amount of $80 million on January 1st, 2024 to Saxton Bowes Corporation. The bonds mature on December 31st, 2033, so it is a 10-year bond. For bonds of similar risk and maturity, the market yield is 12%. Interest is paid semi-annually on June 30th and December 31st. So this is a fairly similar problem to what we saw before. However, in this case, we are essentially amortizing the discount. How do we know it's a discount? Because we can tell The market yield, the market interest is 12%, and Bradford Company is only offering 10%, so the bonds would have been issued at a discount. So the amortization of the bond discount, in this case, it is going to be using the effective interest method versus the straight line method. So the difference between this is that we essentially need to, make sure that the interest that's paid, it is based on the carrying value. So interest accrues on an outstanding debt at a constant percentage of the debt each period. So, this is essentially under the concept of accrual accounting. So in such case, recording interest each period in this example at the effective market rate of interest is going to be multiplied by the outstanding balance of the debt during the interest period. And this is what is referred to as the effective interest method. All right. So not as easy as straight line method. The journal entry is not always going to be the same, or the amount rather will not always be the same, but similar concept nonetheless. So we'll start to look at this problem. First thing we need to do is to calculate the price of the bonds. So in order for us to determine the interest, 80 million. Make sure that I have enough zeros. I am missing a zero. 80 million, perfect. Multiplied by 10%. That is how much we are promising to pay our bondholders. And then since we are making payments twice a year, we divide it by 2. So that lets us know that each year we're going to pay a total of $8 million rather in interest. However, since we're paying them twice a year, we pay $4 million twice a year, $4 million every 6 months. So similar to how we saw the previous problem, this lets us know that it is a 10-year bond and payments are made semi-annually. So 10 times 2, our number of years is going to be 20%, or 20 years rather. And then the next thing we need to factor in is using the market rate, which is 12%, but we are trying to find it on a semi-annual basis. So therefore, we use our present value of an ordinary annuity of $1. We know that it's going to be 20 periods, and then the interest is going to be 6%. So our fifth to last line. So we basically connect the dots. And the interest in such case, our present value factor would be 11.46992. 11.46992. So that gives us a present value for these 20 payments of $4 million. The present value is $45,879,680. And now we need to determine for the principal. So we know the number of periods, which is 20. And then we know that the interest rate is 6%. So we connect the dots. The present value factor for our principal payment at the 10-year period is 0.31180. And the principal amount we know is 80 million. So the principal 80 million discounted, the present value is 24,944,000. So when we add the two, the present value price of the bonds is $70,823,680. So to record our journal entry, it would be accounted for as follows. So we debit our investment in bonds for the full value, which is 80 million. We credit cash because we know how much we paid based on a present value. It is $70,823,680. And we know that the bonds were issued at a discount. So the maturity value minus price paid, there is a discount on investment in bonds for $9,176,320. So discount on investment in bonds. All right, so that's our first journal entry. Now, the second thing we need to account for is our interest. So on June 30th, so we know we're going to receive cash. That's one thing we know for sure. But we need to determine how much. So as we saw in the previous problem, it is going to be the face value times the stated rate times 2, because we're, receiving payment twice a year. So 80 million, which represents our face value multiplied by 10%, which represents the stated rate, the amount we promised to pay, and we divide it by 2 because payments are being made twice a year. We anticipate receiving cash of 4 million. But we know we're going to need to amortize the discount on the investment in bonds. So as stated previously, in order to determine the amount that is going to be received or how much we are going to amortize it, it is always going to be based on the carrying value. So in such case, the carrying value, as we saw in the previous problem, it is always as follows. The investment, I'll write it down here. So interest revenue is the carrying value, which is the face amount of bonds minus the value of discount on investment and bonds. And then we multiply this amount by the market rate divided by 2. So the carrying value, in order for us to determine the interest revenue, it is the carrying value, which is the face amount of the bonds, minus the value of the discount, or let's say the carrying value. So current balance, current balance in the discount and investment of bonds multiplied by the market rate divided by 2. So let's put these, let's attach some numbers to these. So 80 million minus the current balance in the discount on investments in bonds. So we just set up this account. So therefore, the current balance in the discount on investment in bonds is the $9,176,320. We multiply it by the market rate, and the market rate in this case is 12%. And that gave us $8,498,841.60. And then the final step is to divide this amount by 2. So therefore, our interest revenue is $4,249,420.21. All right. So what I'm actually going to do, I'm going to merge this because I don't want you to forget the last step. Multiply by the market rate, and then we'll put the 2 at the bottom. So that way we know that we need to divide that amount by 2, because if we don't, then the amount that we'll get in this calculation would be the annual amount. I just want you guys to see how we got this number again. So it was the carrying value. Here's what I'll do. Again, I know there's a lot going on in the Excel, but I just want to make sure you guys see how the amount was calculated. So we determined the carrying value, which was 80 million minus the current balance. Let's shift this over. All right, so it's the 80 million minus the current balance in the discount on investment in bonds account. And how do we determine? It was the 80 million minus the cash paid. So the current balance is 9,176,320. And then we multiply that by the market rate of 12%. So down below, we'll do the math. 80 million minus the 9,176,320 gave us 70,823,680. And if we multiply this by 12%, that gives us the $8,498,841. And if we divide this amount by 2, that is how we calculated the amount up above. All right, so this is how we calculate the interest revenue. And then the difference between the two represents the discount on investment in bonds. So there's an amortization of $249,421. So we're going to do the same thing for December 31st. So we have cash. We know for sure one thing that's not going to change is they promised to pay us $4 million in interest. We're going to get the $4 million in interest. That will not change. But what is going to change is we are going to see is the amount of the interest revenue. So we already pointed out our interest revenue is calculated as follows. It is the carrying value, which is the face amount of the bonds minus the current balance in the discount on investment in bonds multiplied by the market rate divided by 2. So here we see so using the straight line method, each entry is the same. But again, in this case, we are using the effective interest method. So for us to determine what the current balance is, it'll be the carrying value of the face amount of the bonds, which is 80 million. But then from there, we need to factor in what is the current balance in our discount on investment in bonds account. So let's think logically. Make these a little bigger. So we're going to think logically now, right? So we have discount on investment in bonds, right? The original balance in the account was a credit of 9,176,000. I'm actually going to make this bigger. The original balance was not $9,176,320. Oh, sorry about that. And then on June 30th, there was a debit to the discount on investment in bonds account for $249,000. We'll round it. $249,421, right? So after we made this journal entry on June 30th, the current balance in our discount on investment in bonds is no longer $9,176,320. Instead, it is the initial balance minus the amortization of the $249,421. So therefore, the current balance on the discount on investment in bonds is as calculated, $9,176,320, which represents our original balance minus the $249,421, which was recorded with the June 30th entry. So therefore, the new carrying value for the bonds is 80 million minus the balance in a discount. So before it was 70,823,680, but as we see, it is increasing because at the end of the 20 periods, at the end of the 10 years, the balance in this account should be 0, right? So that's ultimately the goal, that the balance goes down to 0. All right. So here we have the amount. We multiply it by the market rate, 12%. Multiply by 12% gives us 8 million. We divide this amount by 2. So this lets us know that our interest revenue in this case is $4,264,386, and the difference between the two, represents the amortization of the discount. So discount on investment in bonds. All right, so this represents our journal entries for this problem. Again, I know there's a lot going on, but the key thing is that the difference between the first example is the first example, we use the straight line. And in this example, we use the effective interest method, and we determine the interest revenue by calculating the carrying value of the bonds, which is the face amount of the bonds, minus the current balance in the discount on investment in bonds, multiplied by the market rate divided by 2. All right, so this brings us to our next problem. Here it states, prepare the journal entry to record the redemption of the bonds. It states a company retired 60 million of its 6% bonds at 102, 61.2 million before their scheduled maturity. At the time, the bonds had a remaining discount of 2 million, and it's asking us to please record the journal entry. All right. So we know that bonds, they generally have a maturity date for when exactly we plan that, they're going to mature. In one case, we saw that it was a 10-year bond, another was a 15-year bond, but in some case, the bonds are essentially redeemed before they are scheduled to mature. So in such case, they want us to record the journal entry. And we'll record it as follows. So first things first, we know that the bonds were worth 60 million. And then another thing that we know is that they were sold at 102. They had a remaining discount of $2 million. So how much cash did we receive? Cash we received, or cash we paid, rather. So we'll do the calculation down below. We want to know how much cash was paid. Cash paid equals the value of the bonds, which is 60 million, times 1.02. So we know that the cash we paid was 61,200,000. And one key thing to keep in mind with this problem is that it wants us to enter our answers in millions rounded to one decimal place. So for example, 5,500,000 should be entered as 5.5. So we know the cash paid, it's eventually going to be input as 61.2, right? And since we paid the cash is going to be credited, but let's start with our debits first. So we had a bonds payable. We promised that we were going to pay them 60 million. So we are now getting rid of our liability. So we debit our bonds payable for the maturity, which is 60 million. So we'll input 60.0 for this problem. Let me update this. So the bonds payable will be 60.0. Next, something else that we know is how much cash we paid. We calculated it previously. The cash that we paid is 61.2. And then something else we know is that the problem lets us know that the bonds had a remaining discount of million. So we need to account and get the balance in the discount on bonds payable down to 0. So we would credit that account, discount on bonds payable for 2.0. And then based on this information, we essentially know if we had a gain on the early extinguishment or if we had a loss. So based on this, we see the cash that we paid, and also taking into account the discount on the bonds payable was a total of 63.2 million, and the bonds payable had a balance of 60 million. So therefore, this lets us know that there was a loss on early extinguishment and it will be calculated as follows: 61.2 plus 2.0 minus 60.0, and we have to follow PEMDAS. So we add the cash paid plus the value of the discount on bonds payable, and we subtract the value of bonds payable. So the loss on early extinguishment was 3.2. So this represents our journal entry for the loss on extinguishment. This brings us to our next problem, and it asks us to prepare the journal entry to record the issuance of bonds. And we see that in this problem, it wants us to do the same thing, enter our answers in our answers in millions rounded to 1 decimal place. So for example, 5.5 million should be entered as 5.5. So it states here, at the time of sale, the market value of the common stock was 25 per share, and the market value of each warrant was $5. So it states Hoffman Corporation issued $60 million of 5% 20-year bonds at 102. Each of the 60 bonds was issued with 10 detachable stock warrants, each of which entitled the bondholders to purchase $20. Which entitled the bondholder to purchase for $20 1 share of $1 par common stock. At the time of sale, the market value of the common stock was $25 per share, and the market value of each was $5. So, another way to kind of incentivize bondholders is to include what's called detachable stock purchase warrants as part of the security issue. So when there's a stock warrant, it gives the investor an option to purchase a stated number of shares of common stock at a specified option price. So you not only get bonds, but you also have the opportunity to, the option, it's up to you if you want to or if you don't, to basically purchase stock at a specified option price, and you basically have like a limited time. It could be a year, 2 years, whatever it is. It's ultimately dependent on what the company decides, pretty much. So this is like a conversion feature, and this generally allows there to be a lower interest rate, and this enables companies to issue debt when borrowing would not be otherwise feasible. But one key thing is that, with these detachable bonds, unlike a conversion feature for convertible bonds, warrants can be separated from bonds. So this means that they can be exercised independently. They can be traded in the market separately from bonds, ultimately having their own price. So in essence, there's 2 different securities, the bonds and the warrants, but they're sold as a package for a single issue price. So accordingly, the issue price is going to be allocated between the 2 different securities based on their fair value. And this is if the independent market value, if the independent market value of only one of the securities is reliable, then in such case, you can allocate it. So here in this example, we need to determine again what's going on in this problem. So the issue price of the bonds with the detachable warrants, as mentioned, is going to be allocated between the 2 different securities on the basis of their market value. So we want to determine how much cash is going to be received. So how do we determine that? Cash, we know it's 60 million, and it's issued at 1.02. So we have 61 61.2 million because the total is 61,200,000. But again, they want us to round the answer. So this will be 61.2. I'm going to update this format. All right, so 61.2. And then from there, we need to determine the equity, the 61.2. All right, so the next thing that we know for sure is we know the value of the bonds payable. So we know bonds payable. One thing we know for sure is that the bonds payable is 60.0. How do we know that? Again, just like if we were recording a regular journal entry, we debit the cash received, credit the bonds payable, and that would let us know that if it were issued at a discount or a premium, and in this case, it is issued at a discount. Make this a little smaller. All right, perfect. So we can say both. Great. So now in order for us to determine the value of the equity, we would determine it as follows. So equity, and the problem lets us know that each warrant is worth $5. So $5. And then we determine how many warrants are they allowed to get. So it says they can elect for 10 detachable stock warrants. So 5 times 10 times the number of bonds. And there were 60,000 bonds. So 60. So therefore, the equity portion is 3 million. So I'm going to type it out. So price each warrant times the number. I'll actually just put it all in one thing. So that way there's enough space to see everything. So the price of each warrant times the number stock warrants times the number of bonds issued. All right. And again, that's how we calculated the amount. The price for each warrant is $5. The number of stock warrants is 10. And then the number of bonds issued is 60. And that is how we calculated the equity of 3 million. So we would credit our equity stock warrants for 3.0. And from there, we determine the value of our discount on bonds payable. And we would calculate it as follows. The bonds payable, the maturity value that we are promising to pay to our bondholders, plus the value of the equity stock warrants, minus the cash that we received. And that gives us a discount on bonds payable of 1,800,000. So this is our journal entry for this problem where there were detachable stock warrants. So this brings us to the next question. And in this question, we are looking at what's called convertible bonds. So what are convertible bonds? All right, we just saw an example with detachable bonds. So another feature, and again, this is something that can help to appease bondholders, is what's called convertible bonds. So sometimes corporations, they include a convertible feature as a part of a bond offering. So convertible bonds, I mean, when you hear the word convertible, it can, be changed or converted, exchanged for. So convertible bonds can be converted into, and what that simply means is that it can be exchanged for shares of stock at the option of the bondholder. So among the reasons for issuing these convertible bonds rather than just debt is that they can sell bonds at a higher price, which means that this lowers the effective interest cost They could use it as a medium of an exchange and if there's a merger and acquisition. And this also helps to enable smaller firms or firms that have a lot of debt to obtain access to the bond market. So sometimes these convertible bonds, they serve as an indirect way to issue stock when there's shareholder resistance to issuing any additional equity. So just keep that in mind. So these are some of the reasons why convertible bonds, it is attractive to investors. It's kind of like a hybrid security, pretty much, right? It has both the feature of debt equity, which are bonds, and then equity, which is, stocks. You're investing, you have ownership in the company. The owner would basically have like a fixed income security that can become common stock if the firm, makes it feasible to do such. So in this example, it's asking us to prepare the journal entry to record the issuance of the bonds. Hoffman Corporation issued $60 million of 5% 20-year bonds at 102. Each of the 60,000 bonds were convertible into one share of par common stock. So when we are accounting for convertible bonds, there's no provision for the separate value of the conversion option. All subsequent entries, they would essentially include the periodic reduction for the premium as if they were not non-convertible bonds. So our journal entry would be as follows. And again, this is under GAAP. GAAP requires that the entire issue price of convertible bonds, that it's recorded as debt, precisely the same way as though it were for non-convertible bonds. So our journal entry would be as follows. We would debit cash. How much are we receiving? So the bonds were worth 60 million. Let me make sure I have enough zeros. Times 1.02. I feel I am missing a zero. Yes, I am. All right. So $61,200,000. So therefore would be 61.2. Update this format. So 61.2. All right. And then we know the amount of our bonds payable. So we would title it convertible bonds payable. So that's the only difference, with another entry, we would just credit bonds payable. But in this case, we would credit convertible bonds payable. So 60.0. In this case, we receive cash of 61.2 million. And the amount we are promising to pay is 60 million. So in this case, we have a premium on bonds payable. And the difference would be the cash of 61.2 million less the amount that we are promising to pay, 60.0. So we have a premium for 1.2 million. So this represents our journal entry for this problem. Again, the key difference is that when we have bonds that are issued with detachable stock warrants, it needs to be separated, right? We account for the bonds payable, we account for the value of the equity stock warrants, the cash, and then the discount or premium on bonds, if any. But GAAP requires that if we issue convertible bonds, it needs to be recorded as debt the same way as if it were a non-convertible bond. All right, so this brings us to our last question. So for this question, it asks us to determine the price of the bonds at January 1st, 2024. Prepare the journal entry to record the issuance by InstaForm. Assume the market rate was 9%. Determine the price of bonds at January 1st. Assume the market rate was 9%. Prepare the journal entry. And 3, assume Broadcourt Electronics purchased the entire issue in a private placement of the bonds using the data and requirement to prepare the journal entry to record the purchase by Broadcourt. All right, so we already have experience determining the price of a bond. And again, it's going to ask us to use the present value of an ordinary annuity for the interest payments and the present value of $1 for the principal. So I'll pull them up. So for the first part of the scenario, it says January 1st, 2024, Instaform Incorporated issued 10% bonds with a face amount of $50 million dated January 1st. The bonds mature in 2043. It is a 20-year bond. The market yield for bonds of similar risk and maturity is 12%, and interest is paid semi-annually. So we need to determine our interest. And how do we do that? It's the face value of the bonds, which is $50 million, multiplied by the stated rate, which is 10%. And we divide the amount by 2 because interest is paid semi-annually. So every 6 months, $2,500,000 of interest will be paid. And then our principal is $50 million. So the next step is for us to determine the present value factor. So it is a 20-year bond. Interest is paid semi-annually twice a year. So therefore, there will be 40 payments over the next 20 years. So our number of periods will be 40. And again, we always use the market rate of interest. And in this case, the market rate is 12%. So therefore, 1/2 of that is 60. So 40. We're on the last line. We know our interest rate, 1/2 of the market rate. So we connect the dots. Our present value factor for the interest would be 15.04630. So the present value of our interest is $37,615,750. For our principal, we use the present value of a dollar table. So we know the period, which is 40 periods. There's 20 years. Interest is paid twice a year. And the market rate is 12%. Divide that by 2 is 6. So therefore, the present value factor for our principal payment is 0.09722. So the present value of our principal payment is $4,861,000. So we add the 2, we get the sum. So therefore, the present value price of the bonds is $42,476,750. So our answer for requirement A would be $42,476,750. So now the next step would want us to record our journal entry, and it'll be recorded as follows. Investment in bonds for the full face value of $50 million. We would credit cash for the amount we paid. And then the difference between the two, face value minus the cash paid, would represent our discount on investment in bonds payable. All right, so this would be our journal entry for the first part of the problem. And now for this requirement, for 2A, it's saying, for this requiring, it's saying assume that the market rate was 9%, right? So in this case, the company is promising to pay 10%, and the market is only paying 9%. So in such case, we already calculated the interest, which is the face value, 50 million, multiplied by the interest we're promising to pay, divided by 2, which gives us the 2.5 million. And now we need to determine the present value factor. So we know that it's going to be 40 periods. That's not going to change. It's 20 years for the bond, payments are made twice a year, so 20 times 2 gives us 40. But what is going to change is that the market rate is no longer 12%. It is now 9%. So 9% divided by 2 is 4.5%. So therefore, our present value of an ordinary annuity, the factor changes. So instead of 15.04683, it is now 18.40158. So the value of the interest payments is $46,003,950. Our principal value we know is $50 million. And in order for us to determine our present value of the principal, do the same thing, right? There's 40 periods, but now instead of 6%, because the market rate is 9%, we use the present value factor of 0.17193. And our total principal sorry about that. Our principal, the 50 million multiplied by the 0.1793. Okay, let me double check this. There we go. All right, so the value of the principal, the present value of the principal will be 8,596,500. So we add the two. Then the present value price of the bonds is $54,600,450. So in this case, we see that the bonds were issued at a premium. How do we know that? Again, anytime the market is paying more than the corporation issues, it is issued at a discount. There is less of a demand for these bonds because I can just invest or, lend my money in the market and make more interest. However, when it is the reverse and the market rate is less than the amount that the corporation is promising to pay, there is a higher demand for the bonds that the corporation is issuing because it pays more in interest. So therefore, if you want these bonds, you need to pay a premium. So our journal entry would be as follows. We would debit our investment in bonds for the face value, which is 50 million. We would credit cash for the amount paid, $54,600,450. And instead of our discount on bonds, we have a premium on investment in bonds for the difference between the cash paid and the maturity value of the investment in bonds. And this would be our journal entry for the second part of the problem. All right. And based on the problem, it might ask you to essentially determine, hey, how is the interest going to be determined? And again, the interest payment is ultimately dependent on, is it based on the present value, or is it going to be based on is it going to be based on the straight line method, or is it going to be based on the effective interest method? So in such case, we would need to account for, if it's straight line, and let's just say that we are dealing with the discount investments and bonds payable, we would essentially just take this amount and then we would divide it by the number of periods. And in this case, it is 40 periods. So, it's fairly simple for the most part. We just divide this amount by the period. But if we are dealing with the example where they are focusing on the effective interest rate method, in such case, we need to account for what is the carrying value of the bond. And as we mentioned, the carrying value is always going to be the face value of the bonds minus the current balance in the discount bonds or the balance in the premium on investment in bonds. So definitely important to keep in mind. Again, straight line is fairly straightforward for the most part, but when you are dealing with the effective interest, you definitely want to make sure that you are accounting for the value. All right. So as we finish up with this problem, we know that the last part of it basically asked us if we were dealing with Broadcourt and they purchased the entire issue in a private placement, how would the journal entry change? So with this journal entry, oh, and let me actually fix these. So we are recording this. Let me go back to the problem. Give me a second. All right, I'm gonna fix this really quick. So we're actually gonna do this side by side. All right, so I'm gonna clean this up a little bit. All right, because this assignment, or this question rather, wants us to answer the question based on it being issued. Give me a second, pull the question back up. All right, so here we see it for this question. Sorry. So for this question, it wants us to record the entry by the issuance by Instaform. So it wants us to record the journal entry as though we are the company that issued it. So same thing, but it'll be recorded as follows. So we would record the cash received. I'm going to remove the green from here. Clear contents. Nope, clear contents. Remove this. Right? So this would be the correct journal entry. So we would debit cash. We receive cash of $42,476,750. We would credit bonds payable for the 50 million. And then we would debit discount on bonds payable for the difference between the two. All right, so this would be, let me pull them up side by side. And who purchased it? Broadcourt. So this would be the journal entry on behalf of the bond holder. And this journal would be on behalf of the bond issuer, right? So the problem is asking us to record the journal entry for the bond issuer for the first 4 sets. So this would be the correct journal entry. And as we see, it's obviously the reverse. So this would be the correct journal entry for the problem. We would debit cash for the amount of cash received. We would debit discount on bonds payable. And then we would credit the bonds payable. For the bond holder, their journal entry would be as follows. They would debit the investment in bonds, credit cash, and then they would credit the investment on bonds payable. But again, the problem is asking for this. So this is what you would enter for homework. And then for the bonds being issued at a premium, it would be input as follows. And again, it would basically be the reverse. We would debit cash for the amount of cash received, which is the $54,600,450. we would credit our bonds payable for the bond, which is 50 million. I'm missing a zero. For the 50 million. And then from there, we would credit our premium on bonds payable. All right, so in this example, we get to see it from both the investor or the bondholder as well as the bond issuer. So these would be our correct journal entries. We are recording it for the bond issuer. And then for part 3 of the problem, it asks us to record. I'm going to pull it up. For part 3, it says, assume Broadcourt Electronics purchased the entire issue in a private placement using the data from requirement 2 when it was issued at a premium. So for requirement 3, this would be our journal entry. So the issuing corporation would record this: debit cash for 54,600,450, credit bonds payable for 50 million, and debit premium on bonds payable for $4,600,450. And Broadcourt, who purchased the bonds, they would debit investment on bonds, credit cash, and then debit premium on investment in bonds. So this brings us to the end of chapter 14, which covers bonds and long-term notes. Again, we looked at bonds issued at a premium, bonds issued at a discount, convertible bonds, in addition to bonds issued with detachable stock warrants.